Hello and welcome to another edition of 9 to 5 Live. My name is Mark Williams and joining me this morning is Christoph Gort, co-founder of Siglo Capital Advisors. Christoph, hello.
Hey Mark, good to see you. Thanks for having me.
It's good to see you. Thank you for joining us as well. I'd like us to discuss alternative asset classes this morning. I want us to go through what those asset classes are and their relative merits. And if there's some opinions you have on those in terms of whether that is a good time to be investing in those classes, then we'd like to hear that as well. But first of all, could I ask you to introduce yourself and Siglo Capital Advisors, please?
Sure. My name is Chris, and I co-founded Siglo almost exactly 14 years ago with my business partner, Michael Knecht. Before I started my career at the City of Zurich pension fund, which provided a very steep learning curve, working for a $15 billion investor with a large allocation to alternatives, gave me an almost vertical learning curve. I also had the opportunity to do my PhD at the City of Zurich at that time. Very interesting. Then I moved into the fund of hedge fund space, working for a fund of hedge fund in Zurich during the financial crisis, which was a also very interesting period. Not always pleasant, but certainly good to learn things about active trading strategies. And in August 2010, we started Siglo with the purpose of helping institutional investors to invest in alternative asset classes and basically find the right strategies and the right managers in that extremely heterogeneous field, which sounds easy, but is not that easy to implement. Fast forward to today, Siglo has 10 employees. We're specialized on a couple of alternative asset classes, including ILS, private debt, systematic hedge fund strategies, and impact investing. We advise a total of roughly $2.5 billion US. We're FINMA regulated, and our client base is institutional and professional, with a significant bias towards larger Swiss pension funds.
Thank you. Let's just list the various asset classes we're going to be discussing this morning then, please. So systematic, private equity, private debt, infrastructure, and ILS, or insurance-linked securities. Let's start off with systematic. That's an interesting one to start off with, bearing in mind the turmoil going on in the markets in the last few days. How are those systems holding up in the last few days, and what does that say about systematic as a useful asset class?
Well, the first trading days in August have been difficult for most strategies, including longer-term trend-following strategies, because we saw significant reversals in trends. So the short-term performance has been negative, unsurprisingly. On the other hand, shorter-term strategies and also long vol strategies experienced two very good days, because the main purpose is to profit from short-term reversals, breakout volatility. We've seen the VIX spiking to above 60 for a couple of hours to then reduce back to the 30s. And those shorter-term systematic strategies aim to profit out of such patterns. In the longer run, the longer-term trend strategies did very well for us, not least in 08, but also in 22, for example, where we've seen extended periods of decline in equities and bonds, which were both very strong trends, benefiting longer-term trend strategies. So they definitely met the expectation with respect to diversification. Unsurprisingly, the performance in early August varied significantly due to the sharp reversals of some ongoing trends.
What is interesting in the private debt space, and why?
That would definitely, my answer will be too long for this video. But let's start with a couple of basics. Let's define private debt by pretty much everything that is not a bond and debt to a particular borrower, which is a huge field. It includes direct lending, ABL, asset-based strategies, factoring, leasing, special sits, maybe even distressed situations, rescue financing, etc. Super broad. It fulfills an essential part in a economy because there is demand for credit. And not every borrower can issue a 1 billion bond. So somebody has to meet that credit demand. Now, of course, some banks do, but banks have restrictions, capital charges. Lending to sub-investment grade borrowers is expensive for a bank. And this is where the private debt space basically fills the gap and provides debt to a lot of entities, companies, projects. And this is why it's per se a very good complement to a bond portfolio. Again, similar to private equity, execution is key. It's not that easy to find the right strategies and the right managers. It's also relevant to discuss about incentives. If a manager has a very high performance fee, he has an incentive to give debt or credit to riskier parties. Maybe that's not in your interest as an investor because you bear the full loss and he only has the upside on the performance fee. So you want to be careful about incentives, strategies. But in essence, it's a very good complement to a bond portfolio, and it helps to capture a credit risk premium that can be very attractive, and actually today is pretty attractive given how tight spreads on investment grade and also high yield bonds are.
Infrastructure now.
It's definitely been very popular. It enjoys a support from a political level. There is no doubt that the world overall has to invest in infrastructure. If we want to address climate change, we need new facilities, no doubt. The question then is, can you make money? Now, of course you can if you invest into the right products and the right strategies. But again, it's pretty competitive. There are a lot of large investors, pension funds, sovereign wealth funds, who want to own the most attractive infrastructure assets. So don't expect that you can buy great assets at a discount. Why on earth would anybody sell a very attractive infrastructure asset at a discount? There's absolutely no reason to do so. So it's not easy to implement, but it makes sense to hold real assets that are crucial to the success and the growth of an economy. I think it's also vital to consider the need for new assets, because somebody has to pay for them, and the people who invest in them want to make a return. And there is a lot of need for more renewable infrastructure, more modern technology, etc. And this is why it's per se a very interesting field. But never forget that it's competitive, and never forget that many other big players want to get access to the most attractive assets as well.
Just 2 points on infrastructure. You raised one of them. Surely infrastructure is sometimes encouraged. Certain kinds of infrastructure encouraged by politicians and governments. So I'm thinking, for instance, solar power, which 15 years ago was being encouraged quite massively by various governments, and in those cases, they were encouraging to such an extent that they were paying very high premiums for the energy that was going to be produced in the future on those infrastructure projects. So surely sometimes there are unnatural advantages to be had in the infrastructure space. And then secondly, is infrastructure always a protection against lowering interest rates? Has been mentioned by various people who are in favour of infrastructure projects. And are these projects, are they always inflation linked?
Fair question. Let me start with inflation linked. Yes, some of the cash flows should be adjusted for inflation. On paper and on contract, that's great. Another question is if local governments are willing to meet those contracts for the next 20 years. do you take government and political risk? Is it acceptable for an economy to pay a truckload of coupons to an investor that basically the population has to pay? Do politicians, can they support that? Do they get re-elected if they do? So on paper, it's inflation protected. Then some contracts are really with governments, others are more with private organizations. So when we talk infrastructure, it's crucial to distinguish between regulated and non-regulated, concessionary and others. And occasionally those get a little bit confused and mixed up, and that's a risky thing to do. Technically, if an asset provides a important service to an economy, you can expect to make a decent return on a real basis, not only on a nominal basis. But are you sure that the economy really needs that asset? I mean, the case of Thames River in the UK shows that you can lose a lot of money with a service, water, that is pretty essential to an area.
Insurance-linked securities. Talk to us about that.
Well, the idea has been developed in the early 90s, and the idea per se makes a lot of sense. Large natural catastrophes cause huge losses for reinsurance companies. Some potential losses could basically wipe out almost the entire reinsurance companies or industry. So the idea is to delegate or to transfer that risk into capital markets. That makes perfect sense because capital markets are larger and probably in a better position to absorb those losses. What you get is a coupon, a premium, and you get paid if a specific event does not occur, and you lose your investment if the particular event occurs and hits predefined triggers, either parametric or in terms of damage. And this is what you do. The good thing is the occurrence of natural catastrophes are by definition and fundamentally uncorrelated to financial markets. Whether a hurricane forms, whether an earthquake happens or not, is unrelated to the dollar exchange rate versus Swissy or the GDP in the US. So it's one-sided, uncorrelated. And this provides fairly good diversification. The other thing is the premium you can harvest is dependent on the situation and the capital needs in the insurance industry. Shortage of capital, higher previous losses, inflation, all increase the return potential because insurance companies and reinsurance companies need more money. And if they ask for more money, they need to pay higher price for it. This is, again, not directly correlated to other financial markets. And that's why it's a very interesting strategy to diversify. It's seen a tougher period in terms of returns during 2017 and 22, actually. 23 was outstanding with respect to returns for the reasons I mentioned. The reinsurance industry needed more capital, and that's why it became very attractive again. In the long run, we think the combination of the premium you can get and the risk you take being fundamentally uncorrelated, and I explained, is very attractive to investors. And this is why Siglo has been covering it for 14 years, and this is why it's the largest theme that we cover at Siglo.
Okay, Christoph, I think that's all we've got time for this morning. Thank you very much for joining us. I hope we'll be discussing some of these matters in more detail in the future.
Yeah, happy to do so. Thanks again for having me, Mark. All the best, and looking forward to staying in touch. Thanks a lot. Take care.
You too.
Bye-bye.
Have a good day. Bye-bye.
Bye-bye.